Time for the ETF report. One of the beauties of ETFs is it can make it easier to invest in a straightforward way in a commodity or an asset class that otherwise would need you to open, for example, a futures trading account. So today we're zeroing in on the ag sector. Our guest is Sal Gilbertie, CEO of Teucrium Trading and an expert in agricultural commodity ETFs. Thanks very much indeed for joining us, Sal. And I think you want us just to note here, you're not recommending these ETFs. You're just going to tell the viewers how they work and the basic mechanisms of them.
That's right, and thank you for having me. As a sponsor of the ETFs, we're not allowed to give buy or sell recommendations, but we can talk about the fundamentals of the commodities, which is what we're here to do.
Right. Start off with the soybean fund, SOYB. So what are you tracking here? U.S. soybean futures, essentially?
That's correct. It has a combination of U.S. soybean futures in it to minimize the effects of what they call contango and backwardation. It complicated things in rolling of futures positions. Bottom line is it's meant to provide investors exposure to soybeans. So if they believe soybeans would help their portfolio, and they certainly have proven that they can do so statistically, this is an easy way, as you said exactly, to get soybeans in your portfolio using a stock account. It's very simple. You don't have to worry about margin. You don't have to worry about futures trade, the complexities of futures trading. It's all taken care of inside of the ETF, and the ETF is purchased just like a stock. And again, it's designed so that if soybeans go up, the soybean ETF goes up, and if soybeans go down, the soybean ETF goes down.
I know this, I risk getting technical here, and you have deep knowledge of this, but is there ever a problem with these funds of rolling over futures contracts and seeing the net asset value erode?
There is sometimes when the market is in a normal carry state, they call it, when soybeans are worth, well, it happens in any commodity. If you're selling a bushel of something for $10 and you have to rebuy it for, say, $10.10, you obviously buy less of that. So in a normal carry market, that is a bit of erosion, but it's built into the pricing, and investors, it's whether you trade futures, it's whether you trade the ETF, it doesn't matter. It's just fundamental part of the market. So what we've done is simplify all that. Investors, have to face the consequences of it. But if you want to be long soybeans, you either have to buy a bushel of soybeans, you have to buy soybean futures, or you can buy a soybean ETF. And that's the tool that we provide.
And it looks to me like it's tracked soybean, the return on soybeans fairly well over the past year. I'm showing a price change down about 1%. And soybean prices themselves have declined about 1/3 of 1%. So pretty close return to the futures over the past year.
That's right. It should be, because it holds futures. So what the futures do, what the futures that it holds do, then that's what the fund itself will do. And so it's a convenient way for investors to get exposure to soybeans, which, many people will want to do. Grains don't correlate very well with stocks. And so they are a proven diversifier in a portfolio. I think 7 of the last 7 times that the S&P 500 has declined 10% or more, the soybeans have outperformed. So the index that soybean fund follows has outperformed the S&P 500 all 7 of the last 7 times that the S&P was down 10% or more. And so that is a diversifier for portfolios. Now, sometimes the S&P is down and soybeans are down. They're just down less than the S&P. It does diversify a portfolio, gives more stability.
Let's move on to another one. This is the Teucrium Corn Fund, CORN. And it looks as though this one has also done a pretty good job of matching the return from corn. It's down about 13% in the past year. And my numbers are showing that corn futures are down roughly 13%. So again, reflecting the move in the futures.
Right. Again, it holds futures, so it will do what the futures do. And corn is very unique in that since the Renewable Fuels Act in the United States was passed in 2006, 2007, it reset the price of grains globally. And corn prices, whenever they get to about $3.50 to $4 a bushel, in that range. They kind of stop moving lower. They kind of, they'll go lower for very brief periods of time, but that seems to be the futures equivalent break-even price of corn in the U.S. And of course, that's what the corn ETF holds, is corn futures in the U.S. And so it's interesting to note that corn prices have doubled 3 times in the last 17 years from that $3.50 to $4 a bushel area. And corn prices right now are about $4.10, $4.20 a bushel. So we're within 5% or less of that area where people generally begin to accumulate corn in their portfolio. And, in that 17-year time period, people who bought corn when corn was between $3.50 and $4, they had to hold it, in one instance, about a year and a half before prices went up to $7.50. In another instance, they had to hold it about 2.5 years before that happened. Another instance, they had to hold it 6.5 years. So you don't know when it will happen. But what happens is corn prices will hit a break-even price where farmers will just plant something else. And so historically, the price very rarely goes below that $3.50 to $4 range in corn. And when it stops raining, or you don't get enough rain one summer, prices go up very, very quickly. And again, 3 times in the last 17 years, corn prices have doubled from the $3.50 to $4 area, and they're approaching that area right now. So it's something for investors to keep an eye on.
Just finally, very quickly, if we could, wheat, SRW wheat, is down about 9% in the past year. And you offer a wheat ETF, WEAT, and we're looking at the chart for it. And I am showing that one down about 18%. So it looks, I guess there's different grades of wheat. On the surface, it looks like that might have underperformed the actual wheat contract over the past year. But maybe, is it a different type of wheat or something like that?
Well, it could be, and some of the nuances are in the wheat rolls. Wheat markets have been very active globally, and that's caused some pricing dislocations. And again, the ETF itself holds futures, and it will do exactly what those futures do in terms of price movement. If the futures go up, the ETF will go up. If the futures go down, the ETF will go down. There are fees, there are expenses. There's a little bit of slippage when you do, as we talked about earlier in the show, buy and sell those futures. And so those things do affect it. You're not going to get a perfect correlation. And they're not meant to track spot. They're meant to do what the futures they hold to.
Do you ever hear anecdotally that farmers themselves buy these ETFs or short them to as a hedge?
So they're not using the ETFs as a hedge because futures are more affordable for a farmer to use.
Okay.
But we do get many farmers calling us, especially when they understand crops. They're there on the ground. They're there in the fields. They know when there's going to be a supply shortage. We do get a lot of farmers calling us, thanking us for having these ETFs available, because they'll buy in their speculative account or their IRA account. Yes. They actually have called and told us they'll do that when they want to allocate to grains, because they know grains are sitting on those cost of production levels. And if they wait long enough, the chances of them going up is much higher than the chances of them going down statistically.
Sal, thank you very much indeed. Sal Gilbertie, CEO of Teucrium Trading and an expert in agricultural commodity ETFs,